Great. Thanks, everyone, for joining us today. We'll go ahead and get started. I'd like to talk about a few housekeeping items before we dive into the webinar. First, we're recording the webinar, and we'll be sending out the slides and the recording link after the event. Also, please submit any questions you may have for the panelists using the Q&A box, and we'll either answer them directly after the webinar or in the Q&A section at the end. Now, let's get started with our webinar discussing how our nation's hospitals are ready to ramp back up, but their patients may not be, how non-recourse lending can help. Today, we'll be discussing key financing strategies in the wake of starting up elective surgeries. First, I'd like to introduce today's speakers. We'll hear from Greg Falconer, President and General Manager, Ivita Financial. Greg oversees all financial and operational aspects of the business. An accomplished business leader, Greg has extensive experience positioning a wide range of products for success. With expertise in healthcare, information services, and technology, he brings to Ivita Financial a strong sense of strategic vision, customer and market awareness, and an ability to align resources to solve business problems and drive value. Next up, we'll hear from Chris Cox, Vice President of Product and Strategy for Ivita Financial. Chris leads the enterprise growth initiatives, including product management, strategic business development, joint ventures, and more. Prior to Ivita Financial, Chris worked in the financial services sector. He focused primarily on the acquisitions of commercial real estate and distressed consumer asset portfolios. And with that, I'd like to turn it over to Greg to get us started today.
Thank you, Carol. Good morning. Excuse me. The theme of our conversation today is about providers, really for many good reasons. They're certainly ready to open back up, but are the patients ready to be seen? In looking over the COVID numbers just last night, much of the country is starting to see a resurgence, which is not great news. But I think we're in a time when we have to be ready to expect anything. Nonetheless, I'd like to share my thoughts on reopening as it relates to healthcare, hospitals in particular, with an emphasis on the financial implications, not only losing at least a quarter of revenues, the challenges and delays in processing reimbursements related to COVID, working from home, and then the patients themselves, the physical, emotional, and psychological impacts of the pandemic, unemployment, and certainly the civil unrest. Our conversation today will start with the patient, the implications for the provider, and some thoughts on how patient financing could help in these unprecedented times of financial distress on all providers. Our goal here is really to inform and provide insights into the programs in the market today and offer sort of a checklist when considering patient financing. So Carol, can we go to the next slide, please? I think there's long been a challenge in many revenue cycles as it relates to cash collections, AR, and bad debt. The pandemic has just exposed this in an unprecedented way. Cash-strapped hospitals are facing the reality of closing their doors, and even the best performing ones are posting massive losses. As the government restricted elective procedures, which we all know are the primary moneymakers for most hospitals, months of expected revenue was simply erased. Margins are already thin, so the losses continue to mount. The next slide. Unfortunately, despite having all this revenue vanished, the recovery timeline is protracted due to the nuances of COVID-related reimbursements. In a conversation with one of our provider partners, CFOs, earlier this week, I learned that they just received their first Medicare reimbursements for COVID, and that was a claim from an encounter in March. They're having the same challenges with the commercial payers as well, each one having special filing requirements just for COVID, and there's still a ton of confusion out there how to process claims. Fortunately, I think the stimulus funds that were distributed helped immensely, but there's wide debate over how the funds were actually allocated, and given the supply shortages, most of it's already been exhausted across many of our providers. Employees are being furloughed. Work from home has proven to be less efficient than in other industries, So now more than ever, cash is king and a precious commodity that nearly all providers need ASAP. As well, I'm not quite there yet, Carol. Unemployment, I can't go on without kind of referencing unemployment. It's just another element to all of this. While there may be some debate over the actual numbers, I think we can all agree that unemployment is much greater than it was just 3 months ago. Now, some 40 million Americans have filed for unemployment lately. Beyond the obvious economic impacts, the effects of high unemployment on our society are concerning. Mental health, in addition to physical well-being, are impacted. We really do have an extraordinary confluence of factors that expose us in ways we probably never considered. While we all plan for the unexpected, the never event, we don't often consider a plan that combines this many elements across our entire globe. All right, Carol, next slide, please. So let's talk a little bit about how all of this is impacting the basic human condition. Even before the pandemic, coupled with the civil unrest, most Americans really haven't saved as much as we would expect or like. We've been in a world of consumerism in so many ways, and we have to face it. Few of us budget for healthcare costs. Our monthly budgets cover basic necessities of living: food, rent, utilities, car payments, cell phones. As providers, they face the reality that most of their patients simply can't pay for their full patient responsible amount up front or even at discharge. Now, I don't think that this means patients are unwilling. It's just that at times they're unable to bear the full cost all at once. The outcome, one that we really don't prefer, is often people are deferring treatment. I don't know about you, but I think ignoring your health rarely results in improvement of your health, and avoiding necessary treatment usually puts us in a far worse condition. So beyond all this, some patients remain weary of returning to the hospital. The physical, emotional, and psychological challenges we all face with all of these forces coming at us at once. Sometimes we're just embarrassed about our failing health. Sometimes we didn't handle going through this pandemic, this stay at home, this time where our routines are in chaos as well as we had liked. And it's certainly easy to blame it on stay-at-home orders, social distancing policies, and just the general fear of going into a place where code is known to exist. People often defer care. So next slide, please. So to the provider, the reality is that patients are now the third largest payer. They're probably headed toward the single largest payer in only a matter of years. In many of the CFO conversations I've had, there's largely been a consensus that no longer can you simply raise prices to boost net revenues. We're in a situation where we simply can't keep doing what we are doing and expect something different to happen. The increase in bad debt write-offs is astounding, nearly $56 billion each year, and the number's growing. Compounding the situation is realizing that it takes at least 3 months for patients to pay their bills. This delay, now that we're experiencing the pandemic, is exposing providers to even greater cash flow challenges. And then I'll mention it, it's hardly worth mentioning, but most patients prefer to pay their bills digitally, electronically, while 100% of the hospitals polled in a recent survey said they rely primarily on paper billing. So the situation isn't all doom and gloom. There are strategies that providers can quickly implement to boost their overall collection yields, gain an upper hand on bad debt and AR days, all while providing their patients with an affordable option to pay their balances. Finding ways to accelerate cash must be a fundamental strategy as we emerge from this global pandemic, this global crisis. Doing it in a way that is empathetic to the patient and improving the quality and experience provided is really important. It's our mission. It's why we do what we do. We serve those in our community in need with compassion and empathy. At this point, let me introduce you all to Chris Cox. He leads our product and strategy team at Ivita Financial. He will take us through some of the ways we can achieve patient wellness through financial care. Chris?
Thanks, Greg. Let's talk through the nature of healthcare costs, how patients want to pay using a financing plan, and really discuss what tools are available out there in the market. So, and Greg, you alluded to this, healthcare costs are unplanned and expensive. People don't budget for these unforeseen events. When you think about it in your personal lives, think of it like when your refrigerator breaks down. It's not something that you expect to happen. It works every day until it doesn't. And when it doesn't, it causes you problems. Can you live with it not working for a little bit? Maybe, but you should probably go get it fixed. As a consumer, you can go shop for a refrigerator at a variety of price points. And those price points that you have to choose from are really based off of your own purchasing power or income. Once you decide on buying a certain refrigerator, there's typically a low or a 0% interest financing option, which allows you to break down this cost of a refrigerator, which I can tell you from personal experience, it's like $2,000, down into a monthly payment amount. And when we think of consumers and how they manage their finances, they do not look at the refrigerator and compare the $2,000 versus a $2,200 refrigerator. They're asking themselves the fundamental question: does my monthly income cover this expense? In healthcare, patients aren't afforded the same luxury. A patient income does not have any bearing on the cost of the healthcare services that they receive. So as a provider, it's important to give the patient a payment option that really meets their needs in that moment. So what does a patient look for in a financing plan? There's really four key elements that patients want in financing. The first, they want the experience to be digital and mobile. Patients want to have the ability to interact with their financing program. This means making changes to their payment arrangements, adjusting their communication preferences, all doing this in a mobile-centric environment. It's becoming a must. The second is fee structure, having no fees or low interest rates. Healthcare is one of the unique industries in the U.S. where consumers don't feel the same obligation to pay for services as other sectors. So it's important to provide a financing tool to help pay for their service for those services at low to 0% interest rates to encourage repayment. The third is having long repayment options. We just discussed the high costs for healthcare. Trips to the hospital are oftentimes expensive, upwards of $2,000 to $3,000, depending on the type of visit. Having a long period of time to repay the balance really helps to ease the monthly cash burden on the patient. And lastly, all credit profiles not being dependent on a credit score or not having a credit check. So not all patients have access to credit. Traditional lenders use FICO or credit scores to determine who receives credit. A patient doesn't want to hear that they were denied a means to pay off their balance at the hospital due to their credit score. It's a really off-putting conversation. So let's discuss what types of products are out there in the market. So there are three main types of patient financing tools that we see that are available in the market today for providers. So payment plans, recourse lending, and non-recourse lending. So the good thing with patient financing programs is, for the most part, you can't go wrong from the patient's perspective. All of these tools provide the patient the ability to make payments over time and with little to no interest. Now, the aspects of being digital and being available to all credit profiles will depend on the unique offering of the plan, which we'll dive into, starting with payment plans. Payment plans are the simplest form of patient financing. They could be administered in-house, or you can use a vendor who provides the same service just in a more automated fashion. The upside in payment plans is that they are great and easy to administer. They require the least amount of upfront work to stand the program up and getting patients enrolled. And the program terms of a payment plan are controlled by the hospital and can be very patient-friendly in terms of the monthly payment amount. Now, the downside is, believe it or not, you can be too patient-friendly. We've all seen instances where someone has an $8,000 balance who pays $50 a month, despite having the ability to pay more. Under this plan, the patient wouldn't pay off their balance for over 13 years. And that really doesn't help the provider recoup the cost of the services provided. Not to mention, the maintenance and servicing of payment plans is cumbersome, it's expensive, and time-consuming. There's an entire industry built around managing aging account balances and collection rates. It's called banking. So if you're considering implementing a payment program, one thing I would caution, take a look at your expected adoption rates and payment plan structures. And by payment plan structures, I mean the duration of the payment plan. You'll want to make sure that you don't hurt your monthly cash by placing too many patients in payment plans that would otherwise be paying all or some of their patient balance within 90 days of the final adjudication. So that's payment plans. Let's talk through recourse lending. So recourse lending is a bit complicated. So bear with me as I explain exactly what recourse lending is. With a payment plan, the provider receives payments over time directly from the patient. But with a recourse loan, the provider is going to receive the full balance of the loan up front. And then the patient owes and needs to make payments on that balance to the lender. But if the patient falls behind on their payments to the lender will actually pull back the unpaid funds from the hospital. So in an example of $1,000, a patient owes $1,000 to the hospital and takes out a recourse loan. The hospital receives the $1,000. The patient now owes the lender $1,000. And let's say the patient makes $200 worth of payments before becoming unemployed and unable to keep up with their current payment plan. At this point, the lender will stop working with the patient and go back to the hospital and actually recoup $800 back from the hospital to make the lender whole. The patient then their balance is transferred back over to the hospital, and now the patient has to work with the hospital on the remaining $800. So the advantages to recourse lending is that it's great if you have an affluent patient population who has the willingness and ability to pay back their loans. Their loan programs will accelerate cash and increase net collections so long as the consumer repays the lender. There are some disadvantages. One is the structure of the loan, in that if the patient doesn't pay, it does hurt the hospital, and the balance will have to change hands from the lender back over to the hospital. Another thing or feature that recourse loan programs have, some of them, is that the hospital is not funded until the patient actually makes the first payment on the loan. So you set the expectation that a loan is being used to pay for the balance at the hospital, but if the patient doesn't make that first payment, the funds are never dispersed. So this creates a lot of confusion and really lends itself to a complicated reconciliation process, which is never a good thing for patient experience, especially in an event that there is a default and the balance does change hands. Some things to consider. Because recourse lenders have the ability to pull back funds from the hospital, many hospitals won't qualify for the program. A hospital must be considered investment grade in order for a recourse lender to provide service. So the hospitals who actually need the most amount of help in their finances, they actually don't have access to recourse lending, which brings us to the non-recourse lending model. So non-recourse lending is not new. If you remember back in the early to late 2000s, banks were offering non-recourse financing, but they retreated after the recession in 2008. But non-recourse lending is starting to make a comeback. So the question is, why is it becoming prevalent now? Well, for starters, fintech companies have started to become more prevalent in healthcare. And really all fintech means, as it relates to patient financing, is that lenders have become more tech savvy and sophisticated in how they interact with patients, creating a good patient experience. The second trend that's happened over the past few years is that you've seen a focus or a shift in the revenue cycles being back-end focused on collections and billing, and really now moving up to point-of-sale cash collection goals and pre-service cash collection goals, which has really all been enabled by the advent of patient estimation. Patient estimation was still in its infancy back in the mid-2000s, and now it's become ubiquitous across healthcare. Now, think back to the example I used for buying a refrigerator. Imagine you go to your local hardware store to go pick up a new refrigerator, and they can't tell you the price of the fridge. It makes the discussion around paying for it much more difficult. Next slide, please, Carol. So non-recourse lending is simple. It's a financing plan that accelerates cash to the provider. Unlike a recourse program, if the patient does not pay the lender, the hospital gets to keep the loan proceeds. The lender is then responsible for maintaining the relationship with the borrower in the event they fall behind, and working with them to get them rehabilitated and back on track. So some of the pros of non-recourse lending is that it is the simplest and most straightforward form of financing. It also has the ability to increase your net collections and cash position without taking on any risk of patient default. And because it is a non-recourse program, it is available to all hospitals, regardless of whether or not they are investment grade or not. Now, some disadvantages to non-recourse lending. There are some vendors who have hidden interest or origination fees that they charge to consumers. And also, non-recourse programs have the perception of higher fees, but you have to consider the overall impact to cash collections and bad debt reduction. So some things to consider when you're comparing non-recourse vendors: ask questions about their underwriting practices. You want to make sure that if you have a patient population that is has subprime or near prime credit qualities, but the lender only writes loans to super prime borrowers, you're not going to make a positive impact to your patient community. So with that, I'd like to toss it back over to Greg.
Thanks, Chris. That's a lot to kind of consume, but it's a great overview. For you guys today, we've kind of summarized the three main types of patient financing options out there. I'll tell you a little bit about Avita Financial, and then we'll move on to a Q&A. So the next slide really is an infographic that summarizes what we talked about. As you'll see, the key considerations for hospitals when comparing these plans are collection results and the resources it will take for your team to administer and support these plans. We'll send these slides out for everyone, and they'll be available on our website in the resources section after the call. Please feel free to share this within your hospital as you discuss financing programs that are right for you. Our goal here today is to arm you with the information, the questions to ask, and the considerations as you head down this pathway of implementing a patient financing strategy, again, to kind of address the challenges we're facing now with cash and emerging from this kind of global pandemic and global crisis. So to wrap up today's conversation, I want to take us back to why we were here, which was to have a conversation about opening back up and what that really means for providers and patients. We discussed the challenges that COVID has placed on all of us, from the clinical perspective, certainly the revenue cycle, and most importantly, the patient, their physical, emotional, and psychological challenges that we're all going through. Hopefully, we've given you some content that's valuable, timely, and instructive as we all make our way through these unprecedented times, and hopefully emerge better for having gone through it. Also, in case you're interested, our company, Ivita Financial, has what I feel is a great program to address some of the challenges and risks we've talked about today. Next slide. Just a quick plug for what we do. We've purpose-built our non-recourse patient financing program around simplicity, offering patients everything they want in paying for health care while delivering tremendous value to providers, all while minimizing the cost of resources, time, and hassle of implementation. A few of the main points to remember: the program reduces bad debt, helps patients pay their medical bills. It accelerates cash. The funding upon discharge means no more management of the patient account. It's available to all credit profiles. Again, 0%, no fees, no surprises. We feel that this absolutely increases patient sat. There is a tight connection between the financial experience and the clinical experience. A poor financial experience is reflected on your HCAHPS scores. Separating those experiences and entrusting the financial experience with a partner that knows how to care and lead with empathy is really important, and it should lift both experience scores. And then lastly, again, as I mentioned, it's simple to implement, simple to explain, whether you're offering a pre-service, point of service, post-service, the program works for all patients. So Carol, I think it's time to turn it over to you to wrap us up.
Yep, that was excellent, Greg and Chris. Thank you so much. We've asked everyone to submit their questions via the Q&A box, so thanks for that. I've got a couple questions lined up. The first question we'll probably have Chris address. How do non-recourse lenders make money?
Oh, great question. And something we actually get all the time. So I can't talk to how other vendors in this space price for their services, but we use a risk-adjusted discount pricing model. The higher the patient's propensity to pay, the lower the discount, and vice versa.
Okay, perfect. I've got one more question to Greg. We'll have you answer this one. What happens in non-recourse lending if the patient doesn't pay?
Thanks, Carol. That's a great question and one that we talk about a lot. So the non-recourse or no recourse back to the hospital, this essentially means the responsibility to encourage and create programs for the patient to pay is on the lender. So the hospital is kind of out of the equation after the loan is set up. So you want to partner with savvy customer experience and kind of healthcare experience partners that have the ability to kind of work with people, whether they're out of jobs. You know, healthcare is such an interesting industry that when people leave an episode, oftentimes they're out of work or they're in a rehabilitation mode. So working with lenders that are responsive to that is absolutely critical. We're experienced in helping creating successful pathways for our clients to repay. As we own these accounts now, we're fundamentally motivated to help patients be successful in repaying their bills. So it's on us if they don't pay, not on the hospital.
Okay, great. Well, that's all the time we have for questions today. We'll send, as a reminder, the slides and the recording out after the webinar to the attendees, and we'll also post the webinar on our website in the resources section, where you'll be able to find out more information about non-recourse lending, this comparison chart, and IVITA Financial. Thank you so much, Chris and Greg, for sharing this important information, and thank you to our attendees for joining us today. This will conclude our webinar.